Hey everybody, Amanda Russo here, your real estate planner with Keller Williams Collective. And today I'm excited to have Wyatt Fennell with JQ Financial Services on today. Hi Wyatt, how are you?
Good, how are you?
Good. Thanks so much for joining me today.
Happy
It
to
is
be here.
Happy New Year to you. I was gonna say Happy New Year.
Happy New Year.
It is January, so I think appropriately today we're gonna talk about the exciting topic of taxes.
Everybody's favorite topic.
It is everybody's favorite topic. Well, first, give us a little bit of background about you and kind of what brought you into the tax field.
Yeah, so I went to University of Kentucky, got a degree in finance, and just kind of found the company I'm at now. And we are a full service accounting firm, so bookkeeping, taxes. And what makes us unique is that we focus more on the tax planning side of thing. So I'm an enrolled agent, which is a designation that is administered. The examination is administered from the IRS. So all my studying was done on the Internal Revenue Code. So I'm more of a tax professional than like a general accountant, which makes um, us fall into more of the advanced tax planning world, which is kind of how we got connected,
Yeah.
right? Talking about, how that coincides with real estate and how most people, don't think of it being a tax event in their life when they're
Right.
transitioning homes.
Yeah, and so we're going to talk about that a little bit today and just get people thinking about why their homes when we're planning taxes, what matters, and when you're going to sell a home, what kind of tax implications that could potentially have, but also some planning and some strategy. So, if someone is thinking about selling, let's say they're going to look at this year, maybe in the spring, what kind of things should they be asking themselves or asking a tax advisor
Right.
before even putting their home up on the market?
Yeah. So as you know, being in the world, selling a home is an emotional decision, especially when you've been in the home for a long time and, that home is filled with memories and children and grandchildren and all those things. So before even listing the home, I'd say it's nice to get a checklist going. Um, if you've done any additions to the home, um, of course, you're going to think about what you paid for the home, what you're thinking about asking for the home, um, what stage of life you're in. I know that, you know, if you're in the, what I call the tax window from like 55 to 62, you're in your home can be one of, if not the largest asset you have, and you're about to dispose of that asset. So getting in the mindset of, I'm about to have a big stream of cash flow, and how does that coincide with my other streams of income that I'm pulling from?
So you're talking about the people that are maybe empty nesters or they're
Empty
approaching
nesters,
retirement.
approaching retirement.
Maybe
Yep.
they're looking at a I call it a right size instead of a downsize.
Right size. Yeah.
And they're gonna sell the home, but then probably purchase a new one at that
Mhm.
point in their
Yep.
life. So what kind of things should they be preparing for with that?
Yeah. Okay. So, when you're selling a home that you've lived in for a long time, a lot of people call it their forever home, and then they find their right size home.
Mhm.
That's a good phrase. So you need to be familiar with, first of all, once you find out what you're listing it for, you know what you bought it for, right? Um, are you gonna hit the tax exemption threshold,
Mhm.
right? So if you're single, it's 250,000. You're married, it's 500,000. And you have to also be inside a box to be able to uh, utilize those exemptions. So you have to meet the residency rule, and most people are going to hit it, right? So you have to live there for 2 consecutive years and 2 years at least out of the last 5.
The last 5 years.
So
Okay.
most people are going to hit that, right?
Mhm.
Um, but especially around here, if you've lived in the home a long time, it's a very high probability that you're going to be above that 500,000 in gains, right?
Yeah, so you're the difference in the price where you bought it and in the price where you're selling it. So, I do have some clients that are beyond that. Retirement, empty nesters, maybe they're moving into a senior living community, they're probably more in their 70s, 80s, sometimes even 90s,
Right.
and they've lived in these homes for 50 years or more. So, they're potentially seeing a huge gain
Yeah.
in what they paid for the home. So how can they what should they be thinking about as far as strategy? You know, we might have a single person, maybe they're widowed or
Mm.
and they don't have that additional, resident anymore to claim the 500 taxes. What
Yeah.
things could they be thinking about that they've done on the house? How can we reduce some of this tax
Right.
liability?
Yeah. So it's all about getting your basis adjusted, sorry. And by basis, I mean what you paid for the house, right? So for easy numbers, right? You bought a house for $100,000 50 years ago. You're probably going to be above the threshold, right? But say over those last 50 years, you've built another garage, a detached garage, or you've built an addition on the home. You built a new master bedroom, or you put on a new roof. All these things that are changing the physical structure or value of the house, those things add to your basis.
Mhm.
So if over those 50 years you've put in 150, 200,000 worth of structural changes to the house, that adds to your basis. So you just went from 100, you paid 100,000. Well, now you've paid 250, 350, and now you've significantly shrunk the gains portion of the sale, even though you've already spent that money on the addition and doesn't feel like it's not going to feel like you're missing out on the check of the sale of the house,
Right.
but on paper you've
So you
helped alleviate the tax implications.
Yeah, so you mentioned a lot of structural items there. Is it limited on what type of thing you could do? Like, could it be like kitchen remodel or a bath remodel, or is it carpet? Is it paint? Are there certain things that they're like, that's just maintenance?
Right, yeah.
Or is it more,
Yep.
can you add in those types of things too?
Yeah, it's definitely limited. So you have to be discerning about what you're claiming. The Band-Aid stuff, or the TLC stuff we like to call it,
Yeah.
that is not going to add to the basis of your house. It's got to be big structural, you know, big expenditures, right? So we're talking, like we said, detached garages, or a new room, or a new roof. Sometimes you can, like an HVAC system. I mean, that's $15,000, $20,000.
Yeah.
Addition to the house. So those things are going to help add to your basis, but a kitchen remodel, a bath remodel, maybe depending on the elegance of it, maybe.
Yeah. So talk to your tax advisor on the
Talk
things
to your
that you've
tax
done
advisor,
and
right,
see what their advice
Keep
is.
your receipts.
Keep all of your, that's right, because you have to prove that you did these things, right?
Right.
You can't just say that you did.
Right.
And then somebody's going to ask for proof, right?
Yep, because receipts are tax assets.
Okay.
That's people, it's like, oh, well, the receipt's 20 years old. Get a nice metal filing cabinet, put it in the basement, and every time you do anything, just stick it in the filing cabinet.
Folder. It'll be there when you need it.
Right. You'll thank past you for that.
Very good. Well, so a lot of clients that I also assist, besides the empty nesters and the people that are downsizing, are those that are maybe a little later on in life and we're thinking about kind of financial planning aspects as far as protecting assets, or they're looking at trust. Maybe we're thinking about Medicaid, protection, or certain things like that. So I've seen a big myth, and I want you to talk about this, because I've had to tell so many families when they've added their child to the deed or transferred the home to the deed that they think they're doing the right thing. Someone has told them this is the way to protect from probate, or, what have you. And that's actually not the best case scenario for most people. So talk about that and what that does when people make the decision to add a child to their deed.
Right. So more often than not, they saw that on social media, or,
TikTok. No.
Yeah. Your cousin Eddie told you that, right? What you end up doing is putting your child or grandchild in a worse off position from a tax standpoint. So it's always better, and this is morbid, but for your beneficiaries to inherit your assets, not to be gifted your assets. And again, it goes back to basis, right? So if you have a $200,000 home that you right-sized into, and now you need to transition into a assisted living facility, right? You might think, oh, well, I'm just going to give that house to my grandson to help him for a starter home. Well, as soon as you transfer the deed over into their name, you are transferring the deed in your cost basis, right? So say you paid $200,000 for the house, he's getting that house at $200,000. So that way, if he were ever to go sell it, his basis is $200,000. To where, God willing, maybe you move into an assisted living facility and you live for another 10 years. That'd be fantastic. Your family's happy. Well, think about the appreciation of that home in value over those 10 years. Well, now your beneficiary basis is $200,000. So they're going to get dinged with a big capital gain because they inherited it, or they were gifted instead of inherited. Well, if they inherited that house, you get it what's called a step up in cost basis at the current market value at the time that the family member passed away. So if you bought it at 200, 10 years later it's worth 300. Well, now the child, because they're inheriting that asset, gets it at 300,000 at cost basis instead of 200,000 if you were to be gifting it to them. So inheriting is always better. As far as avoiding probate, it's pretty easy to just put that house into a trust, and it doesn't have to have that beneficiary, child, grandchild, adult child, whoever it is. It doesn't have to be put in their name, or they don't have to get added to the deed or anything like that.
Yeah.
If it goes into a trust, that trust is essentially a contract that will disperse that house ownership to who you want it to go to.
Yeah. How
when
you
you
want it
pass
to
away,
go.
how you want it to go to, correct?
Yeah. I see a lot of families that, like folks that want to give their home or leave it to somebody, which is great. But if you want to see them enjoy it before you pass away, I would suggest, maybe they pay a little bit of the fair market value, and it might not be what you would have gotten had you sold it,
Right.
to any person that came in. You might give them maybe a little special pricing for that.
Or they can rent it from you.
They could, yes, and then you could use that for some tax exemptions. But you're still going to help them out in the long run, even though you're trying to save them or gift them that cost.
Right.
You're actually doing them a favor.
You're doing a nice thing,
Yes.
but by effective and efficient tax planning, you're creating a ripple effect that benefits generations.
Yes.
By doing maybe not the most efficient tax things, you're creating a ripple effect that affects your generations maybe negatively.
Yeah.
And you don't even know it, right?
Right. And it's not the intention, but that's how
That's not the intention, but
works out.
that's how it can work out. Correct?
Yeah. So what other things should people be thinking about from a tax perspective if it's somebody that is, planning on moving into a community, or maybe it's an estate, it's somebody that's settling a loved one's estate. Like what kind of considerations should they be thinking about?
Right. So especially when you're moving into a assisted living facility, you can sometimes get medical deductions from your taxes for the care that you're using. And it also can be a pretty good opportunity to revisit, especially in that tax window. I call it the tax window because most of the time when you retire to when you have to start pulling, like physically pulling from retirement accounts. So Social Security, the latest you can pull is 70, and RMD, the required minimum distribution from retirement accounts, is 73. So from that 62, where most people are retiring 65 now, more so these days, to that 70 to 73 range is like your perfect tax window, because you're not bound you're not getting an income anymore, right? You don't have a job, you're not getting a W-2 or 1099 or anything like that. So you have more liberty on how to pull income and how to move assets around to set yourself up in the future effectively. So, it's funny that the conversation stems from, I'm thinking about selling my house. I'm thinking about right sizing, right? And then as you peel back the layers, you find out that there's a lot more that goes into tax planning than just, how can I save on capital gains tax on the sale of my house, right? Because then it makes you start thinking about, well, what do I have? How do I pull it effectively? How do I pull it effectively in the tax sense, right? Well, and then it makes you start thinking about like, well, man, what if I do need long-term care? Because that's not a thing that most people think about either, is needing to go to an assisted living facility.
Right.
The common statistic is that 1 out of every 3 adults will not need assisted living in their life.
Yeah, I think it's 70% will need some type of care.
Right.
Some type of care, whatever that might be, and
Yep.
there's only 30% of us that might not.
Right. And you're pretty lucky if
Yeah.
you're a part of that 30%.
You're in that 30%, you're very lucky, but
Right.
people but what you said is so true. They don't think about that planning aspect at that age, and they don't start thinking about it until they're in their 70s or 80s, and at that point, it's too late. It's too late to start the plan.
Right.
So you had to start that planning early to be successful
Yep.
when that time inevitably probably will come.
Yeah.
So what are some examples? I know you had some scenarios that you want to
Yeah.
kind of go through.
Yeah, we can
Tell
walk
us
through
some
it.
scenarios about how people could handle these situations
Yeah.
in the best way for them.
I can turn this on. We can walk through a hypothetical. I'll pull up it here. There we go. All right, so this is a hypothetical scenario. So this is Mr. and Mrs. John Doe. So they're made up. But we'll lay down some like ground facts, and then I'll walk you through how, if they were to sit down with a meeting with me, what that would look like, right? Okay. So we got Mr. and Mrs. John Doe. They're both 62, lived in their house for 25 plus years. They're looking to right size. I'm going to steal that. I like that because I always say,
Feel free. You can
I
use
always
right
say
side.
I always say downside.
Yeah.
Okay, so obviously they lived in this house forever. It's an emotional decision when they go to sell, but they know it's too much to handle anymore, and they want to move into a smaller home that's more fitting for their needs. So normally, without sitting down with me or another tax professional to do some type of tax planning or future outward look to your tax plan, you just sell the house, buy a new house, and move on, right? Pay your capital gains tax. So if they paid $140,000 for that house, they're asking $700,000 now. For over 30 years, that is around here. It's not out of the
It's possible, right?
not out of the ordinary, right? They're pulling a $110,000 pension from John. They've got $1.2 million in a IRA, so a retirement account, and $50,000 in a Roth. That's their assets on a base level, right?
Okay.
So, like I said, normally they would just sell the house, move on, and go from there. So they sit down with a conversation with me, and I like to deep dive and fact find not just about the current situation you're doing, like, well, what's going to happen if I sell the house, but like, what's going on with your whole life picture, right?
Mm-hmm.
So then we find out they had done additions, so they built a new master bedroom that cost $100,000.
Okay, so that's a basis up.
So that's a basis up, and they had kept their receipts. So good job, Miss John and Jane. They planned on gifting their oldest grandchild the home that they're moving into as a gift. So they're going to give it to him as a gift.
The new home that they're purchasing.
The new home that they're purchasing.
Down the road.
Down the road, they
They
were going to
wanted
gift it to him.
Gift it. Okay.
Right. Their living expense is about $170,000 total, including the pension. They have no long-term care policy, and they have not claimed their Social Security yet. So John's is about $42,000 and Jane's is about $2,800. So here's some red flags before a meeting. They just sell the house and move on, right?
Mm-hmm.
That's going to result in a $560,000 profit, of course, of which is over their exclusion.
The $500,000 for a couple.
So now they've got to pay capital gains on $60,000.
Okay.
They are getting pushed into a higher tax bracket later in life because of RMDs.
Oh.
So because they're not really withdrawing out of that IRA very much, because their living expenses are not very demanding, and he has that pension, that IRA is not getting depleted very much.
Mm-hmm.
And by the time he has to start taking real RMDs at 73 is 11 years from this hypothetical meeting, right? So imagine how much more 1.2 million is going to grow over the course of 11 years.
Sure.
So that's going to be big RMDs, right?
Right. Yeah.
Not to mention at that point, they'll also be taking Social Security. So their income is going to increase exponentially, not out of...
Because they planned well earlier in life, right?
Yeah, because they did all the right things they needed
Right.
to do, and they just, right, you don't know what you don't know, right? So now Social Security and RMDs are getting added, and now you're paying much more in tax later in life than you even were during your working life, right?
Mm.
And they also are putting their grandchild in a tax situation later in life by gifting in the house. And then because they haven't thought about long-term care or assisted living or anything like that, because they're young and healthy and 62, and they're going to be scrambling, or more likely than not, your adult children are going to be scrambling when it's time for you to go into assisted living.
Sure.
Right? So this went from, oh, we're going to right size to there's a lot more things we need to start thinking about from a planning aspect than what we did before, right?
Mm-hmm.
So then this is some things I would suggest that they do hypothetically after the meeting and after we kind of have a nice fact finding, right? So then because they kept their receipts, big point of emphasis, because they had their receipts.
Had that file
Yeah,
in
yeah.
the basement.
Because they had that metal filing cabinet in the basement.
Yeah.
They got to add that $100,000 basis to their
From the new edition.
from the new edition, right?
Okay.
So then there goes any type of capital gains they owe.
So the 100,000 outweighed that 60,000.
Because they dropped them back below that $500,000 threshold. So now they're going to get that. The house is paid off, right? So now they're going to get that $700,000 check clear, right?
Awesome. We love that.
We love that, right? So there's no more worried about timing and taxes and stuff like that because check's cleared, right? And without getting into like numbers wise, they could implement a delayed Social Security claiming strategy and a Roth conversion strategy to start moving that retirement account into post-tax account, so they're Roth. So that way when it comes time to pull money from it, it's fully tax-free. So they're using their tax window, which is the most effective time to do things like this, to move money from accounts into tax-free accounts in order to have less burden on the tax later in life.
So do you have to do that within that tax window that you're talking about?
You don't have to do it
Is that
within
the best time to do that?
It is the best time to do it. You don't have to do it in the tax window, but remember, when you're doing Roth conversions, you're taking money out of your, say, your old 401k, you're putting it into a Roth IRA. Roth IRA is a pre-tax account. When you're doing that, you're paying income tax on that money you're moving.
Right.
Right. So every time you move 50,000 over, you're paying your federal state income tax on that 50,000. But once it drops into your Roth, you've already paid tax on it.
Pre-tax.
It grows tax-free. You pull it out tax-free, right?
Yep.
So what you're doing is you're lowering the amount that's in that pre-taxed account. So by the time you hit 73, your RMDs are a lot lower. So you're paying less
Gotcha.
tax on those RMDs.
Okay.
So now you've moved all that money that's in pre-tax account, put it in a post-tax account, and you're paying a lot less tax later in life. Because now, when you turn 70, you start claiming Social Security, you're getting taxed on Social Security too.
Right. They're going to get it somehow, right?
So you're getting it somehow. So you're lowering your tax burden later in life by using that tax window where there's no income coming in from a job to move money effectively and tax efficiently. So now they get to do that with that 1.2 million IRA. It still gets to grow tax-free, but whenever they're ready to pull it tax-free.
Already paid. Okay.
Oh, and by the way, your beneficiaries get that money tax-free too.
Oh, as long as they name the beneficiaries.
As long as you have beneficiaries on the Roth,
Yeah.
if you were to, God forbid, pass away, all that money in the pre-tax IRA, say it's an old 401k, still goes to your beneficiaries, but they're getting that pre-tax as well. So then when they pull from it, they have to pay taxes on it, but the Roth, they don't.
Okay.
So again, you're setting your beneficiaries up.
So you're
Effective as well.
creating better generational wealth by making a decision like that in that time frame.
Correct.
Rather than waiting until later or not doing it at all.
Or not doing it at all, yeah.
Right.
And the last thing is I would make them have to dive into a conversation about what assisted living looks like. Can you afford to go to a facility? Can you afford to have people come to your home? Right? What does that look like?
Yes.
So that way, in the event that you need assisted living, you have a clear and actionable plan. You're not scrambling. Your family's not scrambling. And, the entire idea around tax planning is that it's clear and that you're in control. And it doesn't feel like you're scrambling and stressed out when the time comes to
Yeah.
make all these big decisions,
Well, like
right?
you said earlier, your kids are going to be the ones that are scrambling and stressed out trying to make
Right.
decisions for you based on what they thought you would want.
Right. And that's
Right.
never fun, right?
No, it's
For
not.
any adult child that's gone through that with their parents will
Yeah.
tell you.
No, it's not fun, and it's best to have a strategy in place and to have those conversations early. Don't
Right.
wait until, it's never a fun conversation. I don't think anybody ever wakes up and says, I'm going to live in an assisted living or I'm going to have to go to a nursing home. But based on the statistics, 70%, we might as well just assume and be safe and assume that it's going to happen
Right.
and have that conversation and that plan in place.
Right. It's better to have the plan and not need it than
Right.
to need it and not have it.
Absolutely. Well, is there anything else tax-wise that you think is an important snippet that you want to share today while we're in that season and people are getting ready to prepare, gathering all their documents? I put you on the spot.
Yeah, right. You did put me on the spot. I would say that it's never too late to start tax planning,
Uh-huh.
even for the current year. Even if you just need simple tax planning for the current year, until April 15th, it's not too late.
Yeah, I'm one of those 14s, and I'm like, oh gosh, let's
Need the taxes done. But no, each tax season, each tax case. So every person, every business is unique. That's why I love my job. It's a puzzle that you got to piece together. And one strategy that works for one person doesn't quite work for another, and vice versa. So I would say, talk to your tax professional. I'm biased. You can talk to me.
Yeah. Well, so how, if you don't have one that you like and you trust and you wanted to reach out to Wyatt, what's the best way for them to reach you?
We have you can look us up on the website. I'm pretty accessible from the community. I'm sure if you asked around about me on Facebook or something like that, somebody's gonna know. And I'm pretty accessible, so it's not hard to find me. Social media, Google me, and I'll come up. Our company's website will come up.
What's the website again? What's the company?
JQ Financial Solutions.
Okay.
So jqfinancialgroup.com.
Okay.
It's our website. See our team. I see all our pictures on there. And like I said, today's a good day to start tax planning.
All right. Well, if you want to start your planning, like you said, now is the time. If you want to reach out to Wyatt, feel free to do so. And thank you so much for coming on
Thanks for having me.
And it's never a fun topic, but it's a very important one. So
Absolutely.
I'm glad we were able to get into it.
Yeah.
Thanks.